Okay, let's get into it. Today we're doing a deep dive on the BlackRock Municipal Income Quality Trust. That's BYM, the ticker.
Yep, BYM.
And this is a really key area for anyone focused on income, right? So our mission, basically, is to figure out how this fund gives you that attractive tax-free yield.
Hmm.
And maybe more importantly, what are the hidden risks? What are the trade-offs?
Well, the big appeal, the siren song for this fund, and honestly, for most muni closed-end funds, or CEFs, it really boils down to the tax status.
It's tax-free income.
Exactly. The income it pays out.
Yeah.
Exempt from federal income taxes, and crucially, also exempt from the alternative minimum tax, the AMT.
Which is a big plus for certain investors, especially high earners.
A huge hook, no doubt.
And it's not a small fund either. It manages, what, around $315 million?
Yeah, about $315.5 million in net assets.
Yeah.
And they have a clear mandate. At least 80% has to be investment-grade municipal bonds.
So quality is supposedly there.
Supposedly. They use diversification, standard stuff, but they also use synthetic exposures, derivatives, ways to potentially boost returns.
Ah, okay. So boost is the key word there. That probably leads us to the yield numbers everyone wants to hear about.
It does. So right now, the distribution yield, based on the market price you pay, is hovering around 6.03%. And they pay that out monthly.
6% tax-free, paid monthly. Sounds good.
It does. But if you look deeper at the actual bonds in the portfolio, the yield to maturity is actually higher, around 7.77%.
So there's a spread there between what the bonds yield and what's paid out.
That's the opportunity, or
Yeah.
part of it. But here's where it gets really interesting, especially if you're thinking of buying.
The discount.
The discount, classic CEF territory. The market price per share is about, say, $11.44 right now.
Okay.
But the net asset value, the NAV, what all the bonds inside are actually worth per share, is higher. It's closer to $12.18.
You're buying it for less than it's technically worth on paper.
Precisely. That's a discount of roughly 9.36%, minus 9.36%.
Which means, for you, the potential investor, there's upside if that gap closes, if the discount narrows. Buying dollars for, like, 90 cents?
Kind of. But, discounts often exist for a reason. The market is usually pricing something in.
And with BYM, there are some big reasons. Risk amplifiers, really.
Two massive ones. Let's hit them head on. First, leverage.
How much are we talking?
It's highly leveraged, about 41.09%. Think about the nearly half the assets are financed using borrowed money or exposure.
Wow. Okay, so 41% leverage on munis. That feels really high. Doesn't that just amplify everything? Gains and losses.
Absolutely magnifies everything. It's a huge bet, essentially. A bet that borrowing costs stay manageable and bond prices behave.
And that ties right into the second big risk factor, doesn't it?
Directly. Interest rate risk, and we measure that with duration.
And the duration here is quite something.
It's staggering, really. The effective duration is about 14.77 years.
Okay, translate 14.77 years for us. What does that mean if interest rates go up?
It means extreme sensitivity. So if the Fed, for example, raises benchmark rates by just 1%, just one, the value of the bonds in this portfolio, the principal, is theoretically looking at a drop of nearly 15%, almost 14.77% to be exact.
Ouch. Okay. So a 1% rate hike could mean a near 15% hit to the NAV before even considering the leverage effect.
That's a raw interest rate sensitivity, yes. Leverage then pours gasoline on that fire, both up and down.
So let's pull this together. We've got high-quality, tax-free income bolted onto some serious volatility potential. What's the verdict for, say, a moderately conservative income investor? Is this too hot to handle?
Look, it offers great diversification within munis, and the tax savings are undeniable. Powerful stuff. But, and this is a big but, you absolutely must be comfortable with price swings. This fund's price is likely to be among the most volatile in the muni bond world.
And that volatility comes mostly from the duration and the leverage, not necessarily the bonds themselves defaulting.
Primarily, yes. It's driven by that long duration being amplified by the 41% leverage. Rate moves get magnified, the price can swing wildly.
So if someone is holding BYM or thinking about it, what are the absolute must-watch items? What's on the dashboard?
Keep it short and simple. Number one, U.S. interest rates and Fed policy. Non-negotiable with that duration. Watch it constantly.
No. Okay. Makes sense.
Number two, track the discounter premium to NAV. Is the market getting more fearful or greedy? The discount tells you a lot about sentiment and potential entry or exit points.
Got it. Discount watch.
And third, keep a general eye on municipal credit conditions. Even investment-grade stuff can be affected if, say, a major state runs into serious fiscal trouble. It's less direct than rates, but still important background.
So summing it up, BYM engineers this high tax-exempt yield by taking on really extreme interest rate risk
Extreme duration risk.
and then cranks it up further with very high leverage.
That's the formula. High-quality bonds plus long duration plus high leverage equals high tax-free distribution yield and high volatility.
Which leads us to that final, maybe uncomfortable question you need to keep asking yourself.
Exactly. Given this whole structure, especially the leverage, what happens if borrowing costs go up significantly in the future?
That leverage gets expensive fast.
Very expensive. And losses get amplified even more. So the critical question becomes, is that monthly distribution truly sustainable from the income the bonds generate? Or is some of it potentially just a return of your own capital?
Yeah. Is it real income or are they just handing your money back to you to maintain the payout level?
That's the core issue. Distinguishing earned income from return of capital is vital when you're assessing the true quality and sustainability of a fund like this. That's what every income investor really needs to weigh.